if a stock that I really, really believe in, that I say I've already bought 500,000 shares at 20 cents, and suddenly nothing has changed, but it's at 15 cents, yeah, I'm going to buy it. I'm going to buy it because I mean, I believe in my own thesis, and if I liked it at 20 cents, why wouldn't I like it at 15 cents?
Well, that's been Buffett's whole idea, is that you should be excited when a stock that you own
That's
goes
where
down.
you make the money. Well,
Right.
That's where he makes the money because, again, he's looking for that 25% return. I'm looking for, like a 100,000% return, right? No, hyperbole, but I'm looking for a home run. He's just, looking to get on base somewhere. He's playing with $1 billion, and I'm not. So, yeah, to kind of summarize, if I like the stock at 20 cents and suddenly with no catalyst driving it down other than the market having a shitty day, I see it at 15 cents, I'm going to buy. And I'm going to average down a little bit, which a lot of money managers say never do that. I've had my Canadian broker said never ever average down, never average down, and I'm just like, so you wouldn't buy Tesla at $125?
All right, let's get started. Welcome to the Angel Research Podcast. My name is Jason Freert, and I'm here with legendary investor Alex Koyfman. Would you call yourself legendary?
To myself, yes.
Iconic?
Yeah.
How long have you been an investor?
Let me see.
Like, how long do you have to be before you're legendary?
Well, I think it's more a matter of how much you made. But
You think that's it?
Yeah. I mean, I started my first trades were made in the early 2000s, so 20 years, more than 20 years.
Right.
My first trade, I actually, there was a company that imploded. Jesus, I can't even. WorldCom.
WorldCom, yeah,
right?
yeah,
And so
yeah.
they were trading at like $70, and the stock collapsed after that whole debacle. And I just thought to myself, well, the stock's going to collapse. It went down to like 7 cents, right? And I was just thinking, there's no way in hell, even with the whole scandal and everything, there's no way in hell this company, just its value
is only worth
just
7
dropped
cents.
by like a factor of 1,000, right? So I figured, I'll buy and see what happens, and I did actually, and it quintupled. I was selling at 35 cents. So of course, then I started getting greedy, and I figured that it would go up to maybe $1,
Yeah.
a little bit more, and then the company reorganized and it just went to zero. So,
man.
so we were talking about catching a falling knife. That might be an example of what that is.
So is that what started your passion for penny stocks?
7
cent
that would be a penny
WorldCom.
stock. I mean, the passion for penny stocks really, I think it comes like more from a philosophical standpoint. These are companies that are essentially startups, and they probably shouldn't be public. Most penny stocks should not be public. There's just too much risk. They shouldn't be available to the retail investor because those are the people that they don't know a whole lot. They can do a whole lot of damage to themselves. But I thought to myself, well, these are startup level investments, and I don't mind the risk. I can still sleep at night doing it, but the gain potential is huge, right? So theoretically, that's and I still stand by that theory. It's just that you really have to sift through a lot of garbage to find those diamonds in the rough, so to speak. So.
Right. And we've talked about this before, but penny stock doesn't necessarily mean that it's trading for pennies, right? How do you define a penny stock?
I usually don't use that term. I think that term it's
because it cheapens it.
Well, it cheapens it. It's misleading because you're right. First of all, it doesn't have to be trading for pennies. I use the term micro-cap or even nano-cap, which is the next level down, and these are companies that are worth below $100 million, maybe below $50 million for nano-cap.
Right.
And so that's how I think that stocks should be classified, is based on the valuation of the company, because Tesla could be trading for 5 cents if they had enough shares out.
Right.
If they reorganized and had like 1 trillion shares, sure, yeah, they could do that. But penny stock doesn't really mean a whole lot. So microcaps is what I like to be involved with.
Okay. And so it's about the market capitalization, which is basically the number of outstanding shares times the price.
Right. And you could have a microcap trading for $10. So
right. So that's what you look at as actual market cap, which totally makes sense. And the quote unquote float that's what causes it also to move a lot, right?
Well, the float is the volume of shares that's actually trading.
Right.
That's available to be traded.
So even if, you take the volume, if there's only, $100,000 being traded in the stock daily or something, then if investors rush in because there's news or some sort of exciting, then the stock moves rather quickly.
Moves radically. Yeah, it's very volatile.
And that's what you're looking for.
That's what I'm looking for. Yeah, that's what kind of gives you that little bit of endorphin rush is when you see volume blow up and then commensurate moves in the price. Then that's kind of what you're looking for. That's not what you should be looking for. You don't want that endorphin rush. Those endorphin rushes usually come with collapses, just like drug addiction and alcoholism. There are very high highs and very low lows. What you want is slow, organic, gradual growth that sort of...
Even in the penny stocks.
Sure. I mean, the ultimate goal of a penny stockholder, microcap company stockholder, is it not being a microcap anymore. You want it to be a small cap and then a medium cap.
Right. And we've talked about this before recently. You took over the Crow's Nest, which is focused on, I don't know what you would call it, small caps, but
small to medium cap.
Small to medium cap. So you've even had, how many have you moved out of microcap status to small cap? Has there been any that you moved in there yet?
No, I have not done that yet.
Okay.
Everything in the Crow's Nest portfolio so far is it's just like dedicated only there. They started off as small caps and they're still for the most part there. So there are potentially a couple that I might be able to move because now they're like in the $200-300 million range. I don't know if really that's the direction we want to take the Crow's Nest. I'm thinking we might want to keep it bigger, just because it's the risk involved, honestly. Like, we classify our readers, based on the stuff that they buy, and I think that they're not looking for the kind of risk that microcap investors are looking for.
Right.
So why mix the two? Since we have a dedicated microcap letter.
And so we've talked about speculating versus investing.
Right.
Would you put microcap investing in purely the realm of speculating? And how would you even define speculating versus investing?
Well, I think that speculation it's essentially the same thing. You're putting money into a vehicle and you're waiting and then you're hoping that it increases in value. With speculators, I think that they are ready to take on more risk. They're ready to lose everything. They're ready to make big gains. I think speculation is closer to betting than it is to investing. And with microcaps, these companies are often pre-revenue, definitely pre-profit. And so you don't have enough fundamentals to be making sort of, measured investment steps, like your investment decisions. You're making speculative decisions, and you're basing it on suspicion, hopes. You're looking at where the market is going and what role this company may play in the future. And so, you look up the word speculative, and there's a lot more doubt involved. With investment, you're supposed to be much more sure. If your bull thesis gets undermined, it's supposed to be because something unexpected happened, or because something new appeared and changed the market entirely. With speculation, if you lose everything, you shouldn't be too shocked. It should just be, it's part of the game. You win some, you lose some, and hopefully you can play long enough to make the big wins, which is kind of my system. I remember, I forget who said this, but it was like a really concise summary of what microcap investing is. It's not how much money you lose. It's not how much money you make. It's how much you don't lose.
Right.
Because the longer you keep doing it, the higher your chances are of finding that one that will completely change your position. So
right. So you're looking for that 10x or more.
Sure.
That really makes all the other losses worth it.
Yeah, exactly.
And it washes out all the other losses.
Yeah.
In terms of breakdown, I mean, either you personally or what you put out there, what do you think is a good percentage for playing in some of these plays? I mean, I think goes without saying that you shouldn't. Let's say you have $100,000 to invest, and that's your total investment capital. I wouldn't say net worth because that necessarily, but your liquid net worth, I guess. Putting that all in 5 penny stocks is not recommended.
Yeah, I mean, I would not recommend that to anybody. Have I done that exact thing? Yes, I have.
Go on.
I am much more risk tolerant than I think your average investor. You still have to do it with a kind of clear head, and you have to be sort of sober about it. But yeah, I have done that. I've put ridiculous amounts of money. I've put 6 figures into a single penny stock before. And as far as percentages go, they say don't invest what you can't lose. So that applies specifically to high risk stocks. You should find your own comfort zone. I think honestly, that's the best way to go about it. Find your own comfort zone. Figure out what your goals are. Figure out how much you can lose. Everybody's going to be different. I'm not a financial manager. I'm not giving anybody any advice. But for me personally, I know that if I do really well just once or twice, it's going to be good enough for me. And so I kind of operate that way. That said, I do have very safe investments. I've been a real estate investor before. I have an IRA. I have ETFs. Everything, it's allocated, but I do allocate more for the very high risk stuff for sure.
Right. So specifics. Let's talk about what's your best investment.
My best investment
in
percentage gain.
Yeah. Well,
I can do both. We can do percentage gain.
Yeah.
So for percentage gain, I had a 20 bagger in 2021, which is pretty good.
In just 1 year?
No, it was not just 1 year.
Yeah.
This was kind of a long hold. This stock was in the portfolio, so my readers actually were investing alongside me for this one. I recommended it to the readers at around 42 cents. The stock, as it often does, dipped almost immediately after the recommendation. It went down to like 17 cents. A couple months went by. I ended up getting in at 25. I bought something like 50,000 shares, so it was like, it was like a $12-some thousand investment, which was a huge mistake because it went up by about 2,000%. With the readers, I recommended that they get out after an only 245% gain, and you can actually see that in the model portfolio. And the reason I did that was because I have a lot more trouble suggesting to other people to take the kind of risks that I take. So I recommended the sale. I held on. And then around 2020, that entire sector that this stock was in, which is in the electric motor, electric car sort of universe, it started to go up, and it started to shoot up pretty dramatically. And I ended up getting out at around $5. So there you go, about a $250,000 win on a single stock that started off as a penny stock, and it was a small cap by the time it was over.
And we don't want to. Is this still in the portfolio?
No, it is no longer in the portfolio, but the stock has dipped because after 2021, that entire sector kind of came back to reality, and it dipped to the point where I think it can be re-recommended again. The company is well along. It's farther along than it was when it was at $5. Company is doing great. The technology is more advanced. They have more deals on the way, but the market isn't cooperating. So it's an inefficiency. I think it would be something our readers might be interested in. But
okay, so you're keeping that close to your.
I'm going to keep that one close to my vest. As far as gains on a single investment, that unfortunately is not going to be a stock. That was the last house that I sold.
Right.
So there you go. That was a safe investment. But it went up 40% in 3 years, which is unreal, too. I think I just got lucky with that. So even after fees and everything, we made over $300,000.
Yeah, I think that is pretty common for people. And it kind of, real estate has been a tried and true investment. There's the reason, Donald Trump and these guys are all into that sort of thing. Over
Yeah.
a period of time, it just appreciates.
It doesn't go down. It may flatline for a while, but it just doesn't really go down.
Right. It's just all the things we've talked about is it's not liquid, right? There is volatility in the market where you might be quote unquote underwater or whatever for a period of time, but it smooths out over a period of time
Yeah.
for the most part.
Yeah,
For the
I
most
mean,
part.
and I don't recommend real estate investment as like a hobby. It was a huge pain in the ass. Moving is a huge pain in the ass, but it was worth it. And one of the main reasons we sold the house was, we got out of that house and bought the next one for cash, and I had enough cash left over to do a bunch of stuff to the new house. And
Right, which right now with interest rates being what they are is a smart move if you can do
yeah,
it.
yeah,
Because if you're forced to pay a 7.5-8% mortgage rate on a house or higher with some sort of jumbo loan or whatever, that's a lot more of a monthly outlay
yeah,
than
that's crazy.
than
People are doing
you're
it.
paying when it was at 2.
Do you remember what it was like in the '90s? Do you remember what interest rate like back then?
Oh well, yeah. I mean, I was in high school in the '90s, but
Well, so I was digging through some of my parents' old files because I was just cleaning stuff up, and I found their settlement statement from 1991. They had something like a 17%
Yeah.
mortgage, which compels you to pay it off as quickly as possible, which is exactly what they did. You can't. I mean,
Right.
that's just. That's unsustainable. But that kind of kept prices down. That controlled the real estate market a little bit. And then the insanity started when we were like 2%. People are buying houses left and right, and so
yeah, it seems concerning that I don't know what the historical average is on mortgage rates, but yeah, compared to that, a 6-7% mortgage rate is
sure.
nothing.
Yeah.
So historically, I think it might be around 5% or something, but the idea of a mortgage isn't even that old, right? I think, go back 75 years, 100 years, and there wasn't even that. You had to pay cash for whatever you get, and most people did not own a home.
Yeah.
So that has unlocked, some wealth for a large swath of the public just by, being able to actually own that, and then it appreciates and people can.
Well, it made banks bigger too.
Right.
So that may be one of the driving forces behind it, is that it's just a huge revenue stream for
Right, and now the
lenders.
banks are just like, forget it. We're just going to buy the house, and we're going to rent it out. We're going to rent it out to you guys.
Well, yeah, is that a sign of decline?
I don't know. We'll see. All right, so switching gears, let's talk about what your favorite stock is or sector is going forward. Are you still on the lithium train?
I'm gonna be on the lithium train. I'm gonna be on the lithium train more so even now than a year ago. And I talk about this almost every week. It's crazy to see what's happening. Lithium prices have fallen somewhere between 77 and 80% since the peaks. The peaks were in like November, December 2022, so a little over a year now. What is Wall Street blaming this collapse on? They're blaming it on sort of lackluster EV sale numbers, right? And if you look at EV sales across the last 3 years, just like a month-by-month chart, and I think we actually have a pretty cool chart that illustrates it. EV sales are increasing every goddamn month. They're increasing year over year.
They just expected it to be like hyperbolic.
Here's what I think is going on. So December 2021, U.S. EV market was something like 50,000 cars sold. December 2021. That same month, the following year, it was 80,000. So we're looking at more than a 50% increase, right? Like 30,000 per month increase. The following year, 2023, December that just went by, it was over 100,000. So we went from a 50% increase to more like a 25% increase, but it's still a similar step up. I don't know if they were just expecting it to go up 50% every month, year over year, just on into infinity, but
right.
they are breaking they're breaking sales records every month. They are making EVs. I mean, these huge companies, these Chinese companies, would not be investing in the industry if the product was a lemon. They just wouldn't be doing it. But yes, it didn't meet Wall Street's expectations. And I think on top of that, lithium speculation was just off the charts. And so if you look at that chart, the EV sales versus lithium prices, you'll see it's just insane. The lithium prices shot up during this same period of time, 2021 through 2023. They shot up from less than $10,000 a ton to almost $80,000 a ton, and then back down to $20,000 a ton. And the pattern of EV sale growth has literally been the same the whole time.
Well, the thing I think maybe gets overlooked in this story is car prices in general, with the pandemic and this whole supply chain shortage, like shot up insane, like used and new car prices shot up in general. So I don't know if just cars in general, we're sort of just getting to a reach where consumers are like, hey, well, maybe I'm not going to, buy a car this year because it's gone up 25%.
Okay, but when did that price skyrocket happen?
I mean, it was like 2 years ago,
which
probably.
was when lithium was topping out.
Yeah,
It was
and I
shooting
think
through the roof
also,
then.
I mean, the longest. I don't know where it is at now as far as hybrids, but it used to be that, if you wanted a hybrid version of a particular car, like let's take like a CRV or a Civic or one of these like sort of base things, you were paying anywhere from $10,000 to $15,000 more for a hybrid version of that car, and it was just a hybrid. We're not talking about a electric vehicle plug-in. It was just you get better gas mileage, and then consumers can do the math and like, okay, I get 8 miles to the gallon more, but gas prices are this, it's just not worth it.
I don't think it adds up. Paying that much more for what you win, I don't think that really adds up. I think that there's a lot more at play. People want to be kind of with the trend, and these sleek new cars are cool looking. I have no idea. I don't think based on that rationale, I would change from the car that I have today, saving, increasing my mileage by 10% or 15% is not going to.
Right.
It's not going to change my mind. But you have to think about the other sort of segments of that same market that drive lithium, wireless devices. That market's blowing up. That's not going anywhere. The average lithium-powered wireless device lasts for 3 years, right? 3 years. So that we need a constant flow of them. There are 22 million wireless devices in operation around the world right now. Not 22 million, 22 billion. 22 billion. And so every 3 years, and the demand is increasing. They're going to be, it's not just that we need to replace those every 3 years. We need more of them and more of them. And so between that and distributed energy storage, the market for just rechargeable batteries, which almost always is a lithium ion, it's getting pushed up, and I don't think it's going anywhere. What happened was the bubble popped.
Right.
The bubble popped. All of those exuberant, crazy investors that thought that this was the next greatest thing, they all cashed out, probably lost money, and so now what happens is we went down to about 20,000, and now we start the slow, gradual, organic growth, the same kind that we saw after the dot-com bubble burst. If you look at, they thought that the dot-com bubble was the end of tech, right? But if you look at the NASDAQ from 2000 onwards, the dot-com bubble was like a little blip on the radar compared to what happened afterwards.
Right.
It exploded, and now it's the whole world. Consumer electronics, just, I don't know, tenfold growth probably since then. So
there's probably a comparison to when oil went up to $150 a barrel, and basically all of the SUV demand fell off the cliff. I mean, that's when Hummer went bankrupt. Everybody's driving these huge, when oil was cheap, let's get these massive SUVs that can't even fit in your garage.
Yeah.
And they had 8 miles to the gallon, and then oil prices, and it was like, oh crap. And people were like, I'm not buying that. I'm not paying that much for gas, and blah blah blah. And then of course, when that collapsed back down, now you're starting to see them come back, but they're just a little bit more, like you said, that organic growth.
Yeah, it's organic. It's not, there's not much excitement there, but it's growing slowly. I think maybe earlier in oil's history, or something like that happened. Like initially in the 20s or 30s, there was a big explosion, and then it kind of dropped off, and then oil became, the thing that ran the world. It was the same way that kind of wireless devices do now. They're everywhere. We couldn't live without them. So, yes. Long story short, I'm still into lithium. Lithium comprises a large fraction of my own portfolio, and I'm, as hard as it is sometimes to watch, the daily price fluctuations, I'm just sitting, waiting, buying more when the opportunity strikes. So I don't know. Yes, I'm sticking with this one. I'm sticking with this one.
And your plays tend to sort of mirror some of the oil plays that we've done well with, which they are not necessarily, they're like more technology plays on actually getting the lithium out of the ground. Because, lithium's interesting. It's like not, I don't even know, like it's not like oil. You just drill down like, hey, there's oil. I mean, or fracking, I guess. It's like they have to do a bunch of shit to get the lithium out.
That's for traditional lithium mining. It's hard rock mining. You have to go in, you have to kind of dig a bunch of rocks out, and then you have to process them. You have to find it first. The exploration itself can take years. So one of our plays right now is a direct lithium extraction company that pulls lithium out of oil field brine, and that is a technology company that came up with a scalable process to source very clean, very cheap lithium from a place where we already know it exists, to the point where we know the concentrations. We can just, almost any oil field brine there is, and oil field brine is what is used in fracking. It's the water that is pumped into the ground. It just basically squeezes everything up to the surface. So yes, they came up with a method to source this lithium much more scientifically. They know how much they're going to get. They don't need to look for it because they already know it's there. So that is one of my favorite stocks of all time, probably. And
stocks of all time? Of
all time, yes. And I don't say that outside of our promotions. I don't say that very often. I think that I'm going to hold on to this one for a while, and I'm very excited. It can literally change the world. It can turn any oil and gas producing operation into a lithium operation in just a couple of weeks. You just install a production plant on site and just filter the water right through it, and you don't disrupt anything of their existing revenue stream. You just create a new one that dovetails very well with where we're going in terms of just decarbonization. So.
Right, and fracking, it's very interesting because fracking has, that's most of the oil production now in the U.S. Right? And the U.S. is now like the top oil producer in the. We're gonna talk to Keith next week, and he knows all about that business. But as long as the environmentalists, I guess, stay out of the way or allow, I don't know what the administration is doing or not doing to allow expansion in here, but if they wanted to, the U.S. can unlock a shitload of oil and just, basically provide all of our oil that we'll need for the next, 50 years, if it is politically allowed to. This seems like it's a perfect just sort of complement to that, like you said, with the transition. It's like, okay, we have to do this oil right now. Everybody wants to, move to a, fully electric grid, I guess.
I don't know about everybody, but a lot of people do think that that's the right way to go.
Right. So you can extract this oil that we need, and we're probably going to still need forever, but also extract the lithium that is needed to make this transition for batteries, electric vehicles,
it's great,
and all that kind of stuff.
And you're right. We can't just swear off oil overnight. The world would collapse if we tried to do that. It's impossible. We still run the vast majority of our road-going vehicles on fossil fuels. So, that's what happens. The U.S. was the first oil market, and it was also the first market to sort of run out of conventionally sourced oil, and we had to figure new things out. And the same thing is working on with lithium right now. We are way behind the Chinese in lithium production, but hard rock mining isn't the way to go. This is the way to go, and we have to be smarter. We can't just work harder because the Chinese have put way too much time and effort into doing it the old-fashioned way, and we can leapfrog them, I think. So,
Yeah, we have the resources, so it's just the will, I guess, political will and the technology we have. So, energy independence in this new environment of geopolitical strife.
it's important. You don't want to be reliant on China and Russia. So,
Yeah, certainly not. Last thing, we talked about how does vanadium play into the lithium story? Is it complementary? Is it the next thing after, or is it just a different use case?
it's a different. I think it's completely different. Different enough that I don't think the two really threaten each other. Lithium ion is the standard for distributed energy storage solutions, but it's not very practical. Lithium ion batteries start to degrade very rapidly after about 500 charge discharge cycles. Vanadium batteries last 20,000 or more. And so if you want to build like a solar farm that has like a 25-year lifespan, and you're going to need batteries, obviously, to store the excess energy, having a lithium distributed energy storage system to go along with that is not going to be very cost effective, even though lithium per kilowatt hour installed is 1/10 the cost of vanadium. But because vanadium is going to last 40 times longer, you're going to end up making way more. It's safer too. There's no fire risk. But vanadium initially is much more expensive. Vanadium costs something like $5 a pound for 95% pure vanadium, but you need like 99.5% to 99.9% pure vanadium for batteries, and that stuff can cost between $100 and $200 an ounce. So therein lies your problems. You're never going to have a phone that you're going to keep for 25 years, right? Like you don't care. By the time your lithium battery runs out on your phone, you're probably going to want to. You're going to be looking for a new phone already. So in that sense, they don't really conflict. But for certain applications, specifically distributed energy storage, vanadium is probably going to become more and more standard. The only problem with vanadium for mass consumption is that 80% of it is consumed in the steel refining. They add vanadium to metal to make steel alloys, and so there's going to be competition for that. But again, if there's more demand for it, we're going to figure out how to get more of it, and if it's cost effective, it's going to be used. So I think there's a big future in that. I'm banking on it. We're pursuing this idea actively for Microcap Insider, and it's not quite as sexy as a Tesla, but
Right.
still, it's distributed energy storage is going to be a big deal, especially for North American infrastructure, because our power grid is overloaded. The power grid is old, decrepit. We can either rebuild it completely, or we can create like these sort of independent little oases of microgrids, is what they're calling them. And
Right.
so that way, it supports the existing power grid, and it also insulates us from blackouts, things like that. So.
Yeah, and I think that obviously AI has been the huge story over the past, I guess, year or two, mainly just the past year since the whole ChatGPT launched. And now I think the first hiccup and bottleneck that existed in the scaling of AI is these chips. That's why NVIDIA has gone nuts. People want the chips, the processors. The next thing seems to be just the data centers, and to run these data centers, you need a tremendous amount of energy, and there's not a lot of you can't just build a data center in the middle of a city, right? You kind of have to have it. It's got to be, you want it close enough to a city, but kind of far removed.
Yeah.
So, and there's just massive power consumption. So a lot of these planned data centers now, they require pretty much their own grid. And a lot of them are wanting to be solar powered. But like I said, you can't, the sun doesn't shine at night. If they're wind powered, the wind doesn't. So they need some sort of storage option for if they're going to run on solar, and so they need these batteries. And so you're saying that that might be something that
I think there's a
vanadium-
good chance that they're probably gonna stick to vanadium because it's so much cheaper over the long haul. It's more reliable. It's again fire hazard. Even though lithium fire hazard is largely overblown, there's zero fire hazard with vanadium. So yeah, and Sam Altman, did you hear what he said about how much money he wants to raise to develop
like $1 trillion
no,
or something?
5 trillion. $5 trillion, which is like 10 times the annual earnings of the entire consumer tech industry.
So he wants to raise it to do what?
For AI chip manufacture in North America.
Okay.
And I think there was like some back and forth on X over it, and at the end of it, he was like, "Fuck it, let's just do 8 trillion." I don't know how serious this guy. I think he may be, sniffing his own farts a little bit too much, but obviously he's a really smart guy. He's sort of on the cutting edge of this new thing. You're probably going to see some form of that happening for sure.
Right.
Especially if the Chinese invade Taiwan. That's going to be...
Yeah, that seems to be right now that the biggest sort of global economic threat is if Taiwan, specifically Taiwan Semiconductor, which provides so NVIDIA, it's not like NVIDIA makes these chips. They are designing them and have almost like a royalty model. They're partnered with people like Taiwan Semiconductor to produce these chips. So if Taiwan gets shut down and they have to shut down that, I mean, the world almost stops immediately.
Yeah, I'm almost, and for that reason, I'm a little doubtful. God, I'm going to eat my words, but I'm a little doubtful that the Chinese are going to do it. They're too smart and they're too measured in the decisions they make. They're basically the opposite of the Russians. And I am Russian, so I can say that. They're not going to, their own business model is going to suffer if they do that. And they've already seen, as an example from the Russians, what happens when invasions like this take place. You may not get what you want, really. And why would the Chinese actually want to change the trajectory of anything right now? It seems like what they're doing is working out pretty well. They should develop their own local chip production, just like we should, for sure. But I don't know if war is in the future there. But it doesn't matter. We still need to have domestic chip production grow by 100-fold. It's stupid to be dependent on somebody that you don't know will be there for you a couple of years down the line. So
yeah, and that takes a lot of investment. I guess
it's
5 trillion, 8 trillion. But I think the thing that people don't really understand about, and it's hard for just humans to wrap their mind around, the exponential growth of these things. Like when you talk about growing at 20% a year or whatever, that if it does that for the next 20 years, it's insane. I mean, if you could compound your money at 20% a year, which is what Buffett does, then you end up the richest man in the world.
Yeah.
So
I think he's averaged 26% for 30 years, and it's just $100 billion personally.
Yeah, and he's playing with these large sums of money, which to me makes it even more impressive because, like you said, he's not buying penny stocks here because he has.
Yeah, he couldn't. I mean, he couldn't really do much.
So people should be thankful that they aren't rich like Buffett, right? Because they get to play in these penny stocks, right?
I mean, he's not even that good at spending money. To him, it's a game.
Right.
So the guy's beach house is 2 rows back from the shore. He didn't even
He
buy oceanfront.
He doesn't even have an oceanfront beach house?
No, man. He bought a used private jet. Still lives in the same house he lived in the 50s in Omaha. I mean, to him, money isn't. It's not about Ferraris and Gulfstreams. It's the game.
Right, and that's probably why he's so successful, right?
Yeah, I think so.
We talked about this earlier. The idea of so you sold the psychological part of investing to me is one of the hardest things to crack.
Yeah.
So, when to sell, when not to sell, when to buy. If you're looking at a stock and you obviously just don't pick a random stock and invest in it, you're researching it, looking at all the different factors, when you know you're going to make an investment in a stock, what's your strategy in terms of like when to actually, are you looking for a dip in the market? Are you just looking for when capital becomes available to invest?
I mean, there's so many different elements that it's hard to create a hard and fast rule with that. Buying dips is, I mean, you see, you only know it's a dip after the fact, right? Because it's more of a decline if you're buying. So, you don't, like the dip has to have come and gone for it to be a dip. So that's kind of tricky. For me, I research the company. I try to figure out what catalysts they're expecting at least. I obviously don't know if the catalyst is going to come or not. But if I know that there are certain things lined up that if they work out the way the company expects, they're going to work out in my favor, then I try to obviously do it before all those catalysts come along. Money being available obviously plays a role as well. If a stock that I really, really believe in, just to get back to the dip thing, if a stock that I really, really believe in, that I say I've already bought 500,000 shares at 20 cents and suddenly nothing has changed, but it's at 15 cents, I'm going to buy it. I'm going to buy it because I believe in my own thesis. And if I liked it at 20 cents, why wouldn't I like it at 15 cents?
Well, that's been Buffett's whole idea, is that you should be excited when a stock that you own
that's
goes
where
down.
You make the money. Well,
right.
That's where he makes the money because, again, he's looking for that 25% return. I'm looking for, like a 100,000% return, right? No, hyperbole. But I'm looking for a home run. He's just, looking to get on base somewhere. He's playing with $1 billion and I'm not. So, to kind of summarize, if I like the stock at 20 cents and suddenly with no catalyst driving it down other than the market having a shitty day, I see it at 15 cents, I'm going to buy. And I'm going to average down a little bit, which a lot of money managers say never do that. I've had my Canadian broker said never ever average down, and I'm just like, so you wouldn't buy Tesla at $125?
I don't understand what's the thought process behind.
I could not figure
averaging?
out. I didn't pursue that conversation. I was just like, okay, look, dude, you have 30 years of experience managing people's money, which makes me think that you didn't make the bulk of your money investing. You made the bulk of your money off fees. So
right.
Not averaging down in the total absence of negative news just seems completely counterintuitive to me. So
right. When you in terms of, like you said, we have IRAs and stuff, the bulk of the gains that you are getting, if you're consistently adding to your IRA or whatever, are going to come on like the down days, right? Because, you're buying as it goes, but if there's a down year where the market's down 20% and you continue to buy during that, then you have that much more capital accumulated when it comes back. Now, that's easy to do when you're just buying like a market index fund or whatever. A little bit, I guess maybe the thought is like, hey, if it's going down, there might be a reason and it might continue to go down. But like you said, you have to have that high conviction in the stock.
Yeah.
So real quick on stop losses. I think we've talked about stop losses before, and would you call yourself anti-stop loss?
Not really. I don't know if I'm anti. Let's just put it this way. Like I've gotten out of the habit of dumping stocks that I've lost on. I have stocks in my portfolio that have been there for years, and I haven't sold them because they're down. I don't want to realize the loss. So I think that stop losses are a good way to keep yourself asleep at night for certain people. For me, I think maybe if you trade enough volume, enough different stocks, and I really don't. I own not that many. I'm very passionate about a couple, and that's what I own. So
that seems to be the focus that we have here at Angel, is like you're going to be digging in and researching a sector, a type of stock, just 24/7, and you stay in that lane so that you are a true expert in that sector. If you're trying to, if you buy too many, you're almost you almost might as well just buy the S&P 500 or the Nasdaq,
Yeah, exactly.
right? So,
I mean,
and
are you gonna stop loss that? Like if you buy
right.
No, you're just going to keep waiting because time is the most important element, really. Time is the most important element in investing. And so, most of the time your time will come. You just need to wait long enough. A lot of people just never get there. Does that make any sense?
It does. I always feel like, and I have done this before, I've done this with crypto, right? Sold too early.
Yeah, me too.
And I've learned over time that you just have to not follow it as closely.
That's true.
And not let it get into your
advice.
head.
Excellent advice. Don't look at the tickers every day. If you bought a stock and you're going to hold it for a year or a year and a half, forget it's even there if you can. And anytime you get like that little bit of adrenaline in your chest that tells you to sell, ignore that. That's the emotion that you're not supposed to employ at all in making these decisions. So
Right. You don't want to start spending that money in your head, like, oh my God, I'm up $25,000 on this stock. I could either sell it and do whatever with it, or I could roll it into another stock or whatever. You just let it ride, and that's
just pretend the money's gone.
Right.
Always.
Always.
As soon as it's bought, it's just like I'm that much poorer now. So that way you're never disappointed.
Right, and that's the whole idea of only investing what you can afford to lose, and which seems to be numero uno maxim.
I would say yes. I would say that's something that we need to make sure that everybody understands. We support. Don't invest more than you can lose.
Right. I feel like we say it every single time. I don't think I did the disclaimer in the beginning either.
Well,
this isn't investment advice. We can only give you the tools and ideas and strategies.
We're just talking.
Yeah, we're just talking
about
right?
stuff.
Yeah, we're just talking about stuff. Right.
So.
All right. Well, thanks again, Alex, for coming on the show. I think we can put a link to sign up to your newsletter and now newsletters, including, we didn't talk about your uber high-end,
we're probably going to have
sort of high net worth investor.
We're going to have to leave that one for next time.
For next time, yeah. It's called First Call, and it's for the
really high risks,
right.
And then they're essentially illiquid or non-public companies that are trying to get public, and private financings of private companies.
Right.
So, but yeah, that's another topic that's interesting.
Okay, we'll do it next time. All right, thanks again. Remember to like, follow, subscribe, follow. I would say follow Alex on Twitter, but I think he's been banned.
Yeah, I
from
was
X.
banned.
Yeah, so you have to sign up to his newsletter instead. All right, thanks a lot.
Thank you.